Thank you, everybody, for joining us for this evening's training. And, I can't tell all of you what you're going to take out of this, but I will tell you that if you apply what you're about to learn, it will, and I can say this truthfully, it will change your financial future. It will change the way you use money forever, and it will put you back in control of your money. If those three things aren't compelling enough for you to spend the next hour and let's just say 40 minutes with us, then you obviously have to put your priorities in a different order. But you're all here, so I know that each and every single one of you are ready to change your lives. It changed my family's life. It will change my daughter's life. It will change my daughter's kids' lives that I will probably never even know. Like their kids will be taught this and will use this. And I won't even know their names. But the one thing I can mark my words here, this grandfather, which is what I'll be at that point, will make sure that every child in this bloodline receives a check on their birthday from Grandpa. Now, some of these grandchildren will not know who Grandpa Chris is, but they'll get a check every single year with my name on it, wishing them a happy birthday. How many of you want to leave a legacy like that? And if it is, all you need to do is pay attention to the next 90 minutes.
Today, we're going to be covering two topics. The first one is going to be around infinite banking. We're going to be covering what becoming your own banker really means, because you may have heard us say infinite banking, be the banker, all that kind of stuff. But what I'm going to cover, this is a presentation I've done before, is what it really means to become your own banker, because there's a couple of shifts we have to have in our mindset and in how we handle our money to become our own banker. We're going to cover that. The second thing that I'm going to be covering also is something new that you're going to hear us start talking about more in our channel, and that's about income in retirement. Because it's, as this video Chris was just alluding to right here, there's a big crisis out there right now where people are retiring or they want to retire, but they don't have the financial means. They don't have the resources or the income to retire like they want. So we're seeing a big crisis coming up right now, and it's going to be very, very pertinent here in the next 5 years because of the quantity of baby boomers that are retiring. And I think Tess actually knows the numbers because she's been looking into it. So I'm going to cover a bit about that, and then we're going to be doing some more presentations moving forward on that topic. So I'm going to go ahead and pull up my screen, and we're going to dive into this. Now, one thing I want to mention to everybody as we go through this presentation, feel free to put in questions. So we're going to be covering what becoming your own banker actually means. So a couple of things that I want you to understand before we get into some of the details is you got to understand when you become your own bank, what does it actually mean? What does it do for you? So here's a few things that it does. So one, when you have your own banking system, the way that we're going to be talking about it, it creates guaranteed, by the way, I love the word guaranteed, and we're going to be using that quite a bit in this next hour and a half. So it creates guaranteed generational wealth day one, also tax-free. So I love that. There's not a lot of strategies that I'm aware of that do this day one. It allows your money to grow uninterrupted, compounded for the rest of your life, once again, with guarantees. I love guarantees, right? It takes control of your money away from the big banks, away from Wall Street, and puts the money into your hands, like control. Because if you want to build wealth, if you want to have more certainty in your life, you've got to control the things in your life, including your own money. Being your own bank allows you to do that. It also protects your money from lawsuits, from bankruptcy, from divorce, creditors, lawsuits in most states. By the way, it's state specific, unfortunately. And Jack, yes, you can only do infinite banking in the US and Canada currently. Yep. The last thing, though, that the being your own bank does for you is it allows you to be the bank for things that you may normally use a traditional bank for. So think of things like real estate investing, college, cars, buying cars, homes, business, retirement, by the way, all those things. But the key thing that this does is it does all of these things at the exact same time, not just one or the other. It does all at the exact same time. Make sense? All right. Now, what I want to share with you some people. So I've been doing infinite banking, been talking about this concept for about, over 10 years now. And so I've helped a lot of people do this, and I've tons of case studies. But this is Doug Fisher from Florida, and this is what he said. He goes, I started a banking strategy, freed up my IRA, and purchased precious metals. I prepared my household for an emergency, and I invested overseas. BYOB really got me off my butt and got me moving on all these strategies. And I feel like I have taken control of my life. So why I want to highlight this one is control. So a lot of people, if you think about it, are we in control of our life? Are we in control of our money? Well, there's certain things that we don't control, but there are things that we should control, such as our money. And that's what this did for Doug. Now, who am I? So I got my start the traditional path in life. So I want to share this if you guys have not heard my story before. So I went to school for construction management and business. Did that career for about 14 years. Hated it, by the way. Did not enjoy it. Great career, but just was miserable, miserable. And so I said, hey, I'm going to go do something different, right? And so I jumped out of that career, probably a bit too early, by the way, but that's okay. And I started my own businesses. And one of those businesses, it taught financial education. And I just want to highlight this business because in 2021, during COVID, this business grew really, really well, did over 2 million in revenue. But why I'm highlighting this is two things. One, the key thing this business did was infinite banking. It taught that concept to a lot of people. So I hope a lot of people do that. But even though I was teaching this kind of stuff, I had a lot of lessons to learn. And one of those lessons was very painful. So this was a tax return on a later year or another year where it was negative $263,000. So I've seen the ups and downs from business, the economy, the markets. COVID, by the way, has infected my businesses. But the one thing that stayed consistent throughout my life has been the infinite banking concept. And so that's why I focus mainly on that now as my main kind of career, I guess I would say. But this is Joe. So I wanted to share this one as well. So this is Joe. And Joe was not in a very good place financially before he heard about infinite banking. And so this is what he said. He said, I'm extremely happy, forever grateful to BYOB for introducing me to this amazing concept. I'll be able to retire very comfortably. So he was very, very scared about retirement. Now, as far as the rest of the BYOB strategies go, honestly, I have been blown away by what I have seen so far. Keep doing what you're doing. I am truly appreciative. So we don't just do infinite banking here at the BYOB group. We do other things, which I'm going to be talking about here a little bit today. All right. So what does becoming your own banker actually mean? So it starts with your mind. It starts right here in your mindset, because as we go through life, we are programmed to think certain ways about certain things, money being one of them. Now, when we're born, do we have any concept around money? Do we understand how money works? No. We learn that, or we are programmed based upon other people, government, education, family, experiences. So when it comes to infinite banking, though, we've got to reprogram the way we think about money. The next thing we're going to cover is the banking problem. Now, why am I saying banking problem? Because there is a banking problem. And what is it? It is the traditional banks. Traditional banks, as I'm going to show you here in a little bit, they destroy money. Which seems kind of doesn't really make sense, right? How are they destroying money? Because they deal with money. They destroy money. It's called the centralized banking system. We'll get into that. Then we're going to talk about the banking solution, okay, which is obviously infinite banking. All right, so it starts with your mindset. So as I said, our mindset, if we don't protect it, is going to be influenced by other people. So if you don't control your mindset, somebody else is going to control it for you. Your knowledge. So we don't really, like when you go to college, by the way, or go to school, do they teach you how money works? Do they teach you how businesses really work? Not really. So where do you get that knowledge? Well, we learn it from other people, but you can also go get your own set of knowledge, which is what we're going to be doing here today. Your beliefs around money. We've got to really understand, do we have good beliefs, negative beliefs? Do we have good habits or bad habits around it? You've also got to understand your goals. So when it comes to being your own bank, you've got to understand, what is this going to be doing for me? What are my goals that this can help me accomplish? Now, here at our team, I'm what's called a money mentor. We have a handful of us that do this. Tess is on as well. She's one of our mentors. So we're going to work with you on that to help identify your goals and to see how infinite banking can help you with that. All right. So what in life should we want to control? I've already told you one thing that I know that we should control, but who wants to use that chat box right there? What are 3 things in life that you should control? Now, health is obviously one that everybody always says, but that's not what I'm referring to. But there's 3 things. Guys, go and use that chat box, put those in there. What are 3 things that you want to control? So Dex says time. He's seen me do the presentation before, I bet. Anybody else? We'll start calling you guys out. Yeah, Tess says mindset is everything. And by the way, Tess has a great story about how she was in the life insurance industry for over 20 years, her career, by the way, never knew about infinite banking, thought this was a scam, came to Chris Naugle's channel to prove him wrong, and ended up now she's on our team. So yeah, so Dex is the original OG. Yeah. So money's one of the first things that a lot of people say when we ask, what should you want to control in life? Now, money though is just a tool. That's all it is. It's just a resource, but you should want to control it because if you don't control your money, someone's going to control it for you. If you're giving your money away to the IRS, that's a 401k, by the way, or giving it to Wall Street, who controls your money now? They do. Okay. What's the next thing we want to control? It's your time. Because once time is gone, it doesn't come back. Money can come and go, but time, once it's out the door, it's not coming back in again. So for me personally, by the way, time is the main thing that I want to control. It's I work from home. I spend my time doing things that I enjoy, which is why I'm here on this call right now. Then, of course, the last thing is the mindset, which I already alluded to. The mindset is the one thing you want to control, in my opinion, before anything else. Because if you don't have the right mindset around money, can you control it well? Right. And by the way, I have personal experience. I have lost well over $500,000 in my life, over seven figures, by the way, because I didn't understand the mindset that I had around money. I had to go change it first. Right. Now, this is the backwards bicycle. You guys may have seen us do this example before, but I want to put it here because it's pretty funny. So this is an example of mindset. So when you're a kid and you learn how to ride a bicycle and you hop back on to a bicycle 5 years down the road, 10 years down the road, you can ride that bike already because you've learned how to do it. You've already been programmed to ride a bicycle. It's pretty quick. Now, let's think about this for an example. Let's say that you have a backwards bicycle, which is the backwards bicycle here. You can Google it after this. The backwards bicycle, when you turn the handlebars to the left, the tire goes to the right, and vice versa. You turn it to the right, wheel goes to the left. Now, the video of the guy trying to ride this thing is hilarious because he gets on this backwards bicycle and he cannot ride this thing. He's falling over, all this kind of stuff. It's hilarious to watch. But eventually, he reprograms his mindset around the bicycle, and now he can ride the backwards bicycle. But guess what happens next? He tries to go ride a regular bicycle, but he can't because he has reprogrammed his mind. He can't ride the regular bicycle anymore until he tries to reprogram around that. Why am I sharing this? It's the same about money. You learned a certain way around money, but it might not be the right way to think about money. So as we learn about infinite banking, we are going to challenge the way that you think around money, the backwards bicycle. All right. Now, there are some books that I want to touch on here real quick because infinite banking is not new. It's been around for a long time. Now, Robert Kiyosaki, author of Rich Dad Poor Dad, he talks about infinite banking in his book Second Chance, by the way. And one of his advisors was my mentor for infinite banking. So I learned how all these guys do this thing in the behind the scenes. Tony Robbins, in his book Money Master the Game, talks about this concept. Then, of course, we've got the book Becoming Your Own Banker by R. Nelson Nash. I have a copy sitting over here. I definitely recommend, if you guys have not read those three books right there, check them out. They are very good books, and they have a lot of stuff around just money in general, but also infinite banking. And of course, Becoming Your Own Banker is specifically around this concept. Then, of course, my friend and mentors, Brent and Chris Naugle, or Brent Kessler, have the book Mapping Out the Millionaire Mystery. And Chris also has the Private Money Guide. And so we have those books for free, by the way. If you want them, go ahead and reach out to us if you want. I'm going to put my email address in here a little bit, and yeah, I can send those to you if you guys want them. Now, when it comes to infinite banking, it's been around for a long time. The first introduction of this concept was in the early 1800s, so it's been around quite a while. So it's safe to say that this has been used for a long time throughout history, but who has used this? So this is one of my favorite examples. This is an article back in 2016 about Jim Harbaugh. Jim Harbaugh was one of college football's top paid coaches, but the University of Michigan paid him through the infinite banking concept, which is amazing, by the way. It's awesome. That's how he did it. Yeah, and by the way, Tiffany, yeah, if you want to put in your email address into the Q&A, I'll make sure that we send you the link to those books, by the way. But yeah, so he was paid through this concept, and there's a reason why they did it this way, which I'll get into on a separate call maybe. Then you've got this guy. Remember him? President Joe Biden. So Joe Biden, Mr. President, has 6 of these policies. Now, these are private policies, private strategies. So how do we know that Mr. Joe Biden has six? Well, when he became the president, you have to disclose a lot of things that you might not otherwise have to. And so we found that out. By the way, the SEC chairman who was just appointed, I think in March, maybe, I think he was appointed in March. I'm trying to remember his last name, but he's the chairman of the SEC now. He has, I think it is 54 in his family, by the way, has 54 of these types of policies in place, right? And he's the head of the SEC. Walt Disney, when he wanted to start Disneyland, he could not get a bank loan from a traditional bank. But guess what? This is back in the early 1900s, by the way. He had a policy and he used that policy to become his own bank and started Disneyland. It's kind of weird to think about this. Without this strategy, we might not have Disneyland as we know it today, which is huge, or Disney, period. Ray Kroc, he used his policies to grow the McDonald's brand when he was taking it over from the McDonald's brothers. Did that in the early 50s and 60s. You've got the Pampered Chef that was started by Doris Christopher, and she used a policy to start the Pampered Chef. Of course, Warren Buffett now has that, and lots of wealthy families have done this. Have done this. All right. So let's go through the banking problem. Okay, the banking problem. So why aren't more people successful? So this is the mystery of money. So here's the things that really kill wealth. So think of things like taxes. Okay, taxes destroy wealth. They can prevent you from being successful, right? You've got inflation, which is inflating of the money supply. You've got volatility. So volatility, by the way, is the markets. If you have a 401k or stocks, market goes up, market goes down. That's volatility. Volatility kills wealth. Interest. Before COVID, the average family was spending around, or average household, by the way, was spending over $19,000 a year on just interest. And I believe that has gone up quite a bit since COVID started. So yeah, interest takes money away. Also your mindset, following that status quo, keeping up with the Joneses, fear of missing out. Life in general can impact your mindset. And then, as I mentioned before, what we're taught as we go through life can really prevent us from being successful because we might not be thinking the right way around money. So as we go through this really quickly, I want to make sure we understand a few things. So first, what is the definition of money? It's just a means of exchange. That's all it is. Think about this. Are your dollars worth more today or in the future? This is kind of a weird thing to think about because if you had $20 20 years ago and you went into a candy store as a kid, you're going to walk out with bags of candy for 20 bucks. It's going to be awesome. You're going to have, you're going to have cavities for years. But if you went to a candy store today with 20 bucks, you might get like 4 or 5 candy bars if you're lucky, right? So it's changed a lot. So we know that our money is worth more today than it is going to be down the road. Also, are taxes going to go up or going to go down? Well, if we know the answer, they're going to go up. I wish they would go down, but yeah, I think our government has a spending problem and a big deficit problem. So taxes, they're going to go up. So knowing that, what do you know about your retirement account? So I'm referring to things like a 401k or an IRA. Those defer taxes down the road. Well, wait a second. If I just said that taxes are going to go up, that means you're going to pay more taxes down the road on those dollars versus paying taxes today on that same dollar. Also, if your dollars are worth more today than down the road, do you want to be taxed on your money today or down the road? It's kind of an interesting question. But with the infinite banking concept that we're going to be talking about, we're going to pay taxes today and then never pay taxes on that money and the growth of the money again. Pretty cool. All right. So to understand the banking problem, we also got to understand the annual pattern of how we spend money. Now, this is a household, by the way. So the way that it works is, so it's kind of a weird little visual here, but for every dollar that comes into your hands, that money goes back out. So here's the way that it works. So 20 cents of every dollar goes to automobiles. 30 cents of every dollar goes to housing, mortgage, rent, things like that, repairs, upkeep, etc. And then 40 cents of everything goes to everything else, things like travel, entertainment, food, etc. Okay, what's left? About 10%. Where's that go? Hopefully it goes to savings, by the way, but most families right now are not saving what they should be, but we hope that 10% goes to savings. Now, let's look at how infinite banking can reverse this because we want to recapture interest. So let's start with the savings, okay? That's 10%. So let's see what happens when we start to recapture interest that's going out the door to other people. So on automobiles, roughly 5 cents of that 20 cents that we spend on auto goes to interest. Well, what if we are the bank and we recapture that interest? Okay, goes back into our savings. Next up is housing. Well, if, what does I say, 30 cents? So 30 cents of that goes out to housing, right? How much of that is interest? Now, if you have a mortgage or an amortized mortgage, it's around 25 cents of the 30 cents is going to interest. That's a staggering amount of interest, by the way. So what if we recaptured that into savings? Savings goes up a lot, right? Then you've got everything else. So 40 cents goes to everything else. And let's say that of that 40 cents, let's say 5 cents is interest because of credit cards and things like that. Let's recapture that. So visually, can you see what's happening when we start to recapture the interest that we are paying to banks? Okay. And by the way, Tiffany, I got your information in there, so thank you for that. And I got your email as well, and Jay, I got yours as well. So yes, we'll get those books out to you. Yep. All right, let's move on here. So when it comes to banking or being our own bank, we got to understand how money flows to understand the banking problem. So what I want to look at is a traditional banking transaction that we all are very familiar with. That transaction, by the way, is buying a car. Most of us had bought a car, whether you did it for cash, whether you got a loan for it, doesn't really matter. In this example, we're going to go buy a $25,000 car, but it's going to be a bit different. So in this scenario, let's just say that you have $25,000 of cash at your local bank, all right? And you go to that bank and you go to the banker guy, Mr. Banker Bob. Banker Bob says, what do you want to do? He said, I'm going to take out my $25,000 in cash and I'm going to go pay cash for the car. But Banker Bob says, hey, Brian, wait a second. Stop. What if I do this for you? What if I keep your $25,000 and I pay you 4% on that money? Okay. So Banker Bob's going to pay you 4% on that $25,000. And Banker Bob says, Brian, I'm going to give you a loan of $25,000 because your cash is the collateral for that loan. But I'm going to give you a loan at 6% on a 5-year note. That's 60 months, by the way. Okay. 5 years. All right. Does this make sense? Would you really want to do this? Well, let's do the math on it because math is just math. All right. So the monthly payment on that car note is going to be $483 per month. All right. What is the future value of those payments? It's going to be right around $29,000, $28,999, by the way. All right. So that's the future value. But what has your money in the bank been doing at 4%? Because keep in mind, you're paying 6% for that loan. But what's the loan doing, or sorry, what's your cash doing in the bank? The future value of that money in the bank is $30,525, which means, by the way, that you made $1,526 paying 6% and earning 4%. Now that's a traditional transaction, but what if you were the bank, you own the bank, you're Banker Bob, and you're the one taking the loan out? You're also the client. You benefit greatly. And we're going to go through a bit more of that. But that's a traditional banking transaction. But the point I want to make here is that you're made money while paying 6% and earning 4%. That seems counterintuitive, but math is math. So the banking problem. So here's one of the big banking problems. So let's just say that you give $100,000 to a bank. And that bank is going to be nice and give you 4%, like I mentioned before in that one example. But what does the bank do? The bank does not just sit on that money. They put the money into motion because money in motion makes money. And they do this over and over and over again. Home loan. Seller takes the cash, puts it back into a bank. They lend it back out on a car loan. Money goes back into a bank eventually. They lend it back out again, back and forth, back and forth, back and forth, to the point where eventually the bank is paying you 4%, but they're making 500% more on your money than they're paying you. It's just math, by the way. It's just math. So banks put money into motion. We don't typically do that, but when we are the bank, we can do the same thing that banks are doing with our own money. And by the way, you can go to BauerFinancial.com, and they will actually show you how much banks have made on your money throughout history. And it's pretty staggering, between 400 and 1,300%. It's pretty crazy. So banks control money, right? That's how they do this. They control your money, and we let them do that. And by the way, has anybody ever read the fine print on your checking account agreement with a bank, like a CD? Most people have never done that because the banks don't really make you read it. You sign off on it or you agree to it, but you don't read it. When you deposit money at a bank, legally, they control your money now. They own your money. Yeah, it's pretty nuts, pretty nuts. So when you have like $100,000 and you put it into your bank, keep in mind, you no longer control that money or you don't even legally own it. Pretty nuts, but that's the way it is. And so what destroys money? So inflation destroys money. And now this is a quote by Thomas Jefferson. And it's a great quote. And it says, because it's kind of blurry, and it says here, if the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. The issuing power should be taken from the banks. I'm going to repeat that. The issuing power should be taken from the banks and restored to the people to whom it properly belongs. Now, there's a concept that he's referring to. It's called Austrian economics. Austrian economics is an economic belief that the power of money should be in the hands of the people. Keynesian economics, which is what the United States and most countries follow, is the Federal Reserve and the banks have the power. And so what Thomas Jefferson is referring to is not what we are currently doing and how we're operating as a country today. Pretty sad. Yeah, Brett, it's pretty sad. It is. So inflation. What creates inflation? Does anybody want to take a guess in that chat box right there as to what inflation really is, or what inflation is, how it's created, by the way? Yeah, yes, yeah. We should know about it sooner too. Yeah. So the first thing that creates inflation, by the way, what is inflation? Inflation is the inflating of the money supply. So this is a great one. So right there, so Brad just said, wow, all these otter plans keep coming in. So Brad just said, mostly by raising prices. Raising prices is the result of inflation. It's not the cause. So what is inflation? Inflating of the money supply is done by two things. First off, by the Federal Reserve. So the Federal Reserve prints money. They're a printing press. Now, by the way, I hate the name Federal Reserve or central banking because they're not, it's a private thing. It's not federal. Actually, it's kind of weird. But anyways, they print money out of thin air. So if more money is in circulation, it means that our dollar has less buying power, which in result causes prices to go up because you don't have as much buying power now. And they have done this throughout history. But when did it start? It started when they created the Federal Reserve in 1913, I believe is the year, and the IRS, by the way, too. That's when it happened. It didn't happen before that. But that's the first cause. Now, it takes, in my opinion, this is my opinion, by the way, about 3 years for the money they print out to really filter its way down into the economy. But where does money end up? Yeah, they have no reserves. That's, yeah, Mario, good point right there. Federal Reserve, not federal, and no reserves. Makes no sense. But anyways, where does the money they print out end up? Okay, it ends up, by the way, in what I call the fractional reserve banking system. Traditional banks, by the way. So what is fractional reserve banking? It is I cannot understand why this is even legal. It's the fact that banks can take in like $1,000 and turn around and lend out 9,000. So they can lend out 9 times approximately what they take in. Now it takes time for this all to occur. It's why we are seeing inflation today. But when did the last big kind of push for inflation start? COVID, beginning of COVID, by the way. But the banks turn around and they lend money out of thin air, which puts more money into circulation. So if you go back to Thomas Jefferson's quote, he's against fractional reserve banking. And if he was alive, I bet you he'd be against the Federal Reserve as well. Yeah. So how do we get rid of these things? Well, we're going to get into that in a little bit. All right. 5 rules for infinite banking. First, you got to think long range because this is not an easy button, right? It's not a get rich quick scheme. You got to think long term. Don't be afraid to capitalize. What does that mean? It means do not be afraid to fund your infinite banking, your banking system. Okay. Whoops. Don't steal from your system. What that means is, hey, if you're going to treat a traditional bank good, treat your own bank better, right? So if you're going to take a loan for a car from a bank, traditional bank, are you going to pay that loan back? Yes. So if you're going to take a loan from your own bank, would you pay it back? Absolutely. Don't steal from your system. Don't do bank or business with banks. Now, there's an asterisk next to that one because you can still use banks. When it comes to investing, building wealth, all that kind of stuff, look at all the financial means that you have available. But when I look at that one, what I interpret that one as is this: don't do business with banks, meaning don't go to a bank and get a loan and have a liability on your balance sheet. Because a liability takes money from your pocket and puts it into their pocket. If a bank is going to give you a money, create an asset with it first, not a liability only. Create an asset. Think of like real estate. Okay. People go and buy a home with a mortgage, and then you pay for 30 years to the bank, and they made a bunch of money. And you have no asset. Your house, by the way, is not an asset. But if a bank's going to give you a mortgage and you go buy a rental property, now you have an asset that takes care of the liability and you're building wealth. Okay? Last one is rethink your thinking. So we've already talked about that. I'm not going to cover the mindset side again. So what is the banking solution? So infinite banking, right? Or banking in general. So by the way, banking is a process. It is not a product. A lot of people get that confused. They think, oh, okay, what's the product for banking? There is no product per se. It is a process of using certain types of products. Because when it comes to infinite banking, you have premiums, you have dividends, you have death benefits, you have loans, you have loan repayments, you have mortgages, you can have all these different things working together in that banking process. But at the core of it is what? It's a pool of money. But you want to make sure that you control that pool of money. All right. So let's go through what the infinite banking machine is. So here's how I look at infinite banking. I look at infinite banking as like a car, the process. What does a car have? A car has wheels. Hopefully it's got wheels, right? Hopefully it has brakes, things like that. Windshield, seats, all that kind of stuff. A radio maybe, mirrors, all that. But what does a car or the infinite banking concept, what does it need to actually operate, to go down the road? It needs 2 things, by the way, 2 main things. Okay. Now, first one, it needs fuel, right? You got to fund the policy, you got to fund your bank. So you need fuel. The second thing it needs is it needs an engine. Without an engine, the infinite banking concept or that car doesn't operate. It can't go anywhere. It's going to sit there in your driveway and not move. Now, what is the engine that allows infinite banking to function, to that car to go down the road? Well, there's different types of engines, by the way. Okay. Now, we believe that there is the most efficient engine possible because you're not going to go get a Honda Accord and slap in a V12 1,000 horsepower motor into that car. It wouldn't make any sense. You want the best engine for that car, the infinite banking concept. And the best engine is a specially designed, dividend-paying, permanent whole life insurance policy from a mutual insurance company. Now, why do we say that? One, dividends. Dividends are what grow infinite banking with guarantees. Okay, so we want to have dividends coming in. We want those guarantees. Okay, we want it with a mutual insurance company. Why mutual insurance company? Because they are owned by the policyholders. They're private companies. And because we're owners, so you and me are owners of the company because we have policies, we get the benefits, which are dividends. All right. Now, one thing I also want to mention is infinite banking has been around for a long time, as we've already mentioned. So throughout history, what has been the vehicle that people have used to do the infinite banking concept? It's whole life insurance. Now, there are other engines. IULs, which is an indexed universal life. There's a variable universal life type of insurance. You have insurance, you have policies that are with stock companies and not mutual companies. You can even use 401k loans to perpetuate the infinite banking concept. But are they the best fit for it? No, they are not. Whole life is the best fit. And to prove that, Who's the biggest buyer of whole life insurance policies? It's actually traditional banks. So what was the problem? It's a banking problem. It's traditional, um, it's traditional banks. But guess what they're doing with your money? They are buying whole life insurance policies. They own more life insurance than they do their buildings and real estate combined. So if they're doing infinite banking and we're going to do infinite banking, would we use a different engine? Absolutely not. We want to use the most efficient engine possible, and that is a whole life insurance policy with a mutual company, specially designed, by the way. All right. Okay. So what I want to go through next is when it comes to infinite banking, I want to go through how this can work, not just for you, but for your family, for generations, because infinite banking, one of the most powerful things about it is the generational wealth aspect of it. The Rockefeller family, by the way, and there's a great book called What Would the Rockefellers Do? They've been doing infinite banking for over 100 years. Actually, 100 and I think it's like 50 years almost, they've been doing this. Now, why would they do that? Because they know that they can put in $1 into this system and use that dollar throughout that generation's life. And that $1 is going to turn into 10 to 15 times that money for the next generation, tax-free and guaranteed. Gee, I wonder why they get wealthier every generation, because they're 10xing their money guaranteed. And you can do the same thing. So why infinite banking works. So one, privacy. It privatizes your money. Most of your money, by the way, is public. If it's in a checking account or a 401k, it's public. This privatizes it. It protects your money. If you're going to work for money and make money, you better protect it. Guaranteed growth. Does a 401k have guaranteed growth on it? No, it does not. I'm going to get into that here in a moment, but it does not guarantee your money. Tax-free generational wealth. I just explained that a little bit, but it does that day one. You have control of your money. You want to maintain control of your money and have it grow at the exact same time. You can be your own bank for banking transactions in your life or banking functions such as borrowing or buying cars, college, all the stuff I mentioned before. You can do this for your entire family and set up generational wealth. Because you can, and I'm going to show you some diagrams and some case studies of how people have done this. And once again, I'm going to say it again, guarantees. When you have guarantees around your money, you have certainty. And a lot of people do not have certainty around their money. And that is one of the biggest stresses that most people have in life, by the way. And also in retirement, money is one of the biggest things that people are stressed out about in retirement. You don't want to be stressed out about that in retirement. But the one thing too that this allows you to do, infinite banking, is you can have multiple banks. And so that's called multiple policies, by the way. And so we call that your banking system, because if you walk around a big city, you're going to see a Chase Bank right there and a Bank of America right over here. You keep walking, what are you going to see? Another Chase Bank, another Bank of America. Well, guess what? You can do the same thing with infinite banking. All right, so when it comes to infinite banking, there's really two pillars of the family banking system. And it's going to be the spouses or the parents, typically the two people right there, right? And so when you look at getting something like infinite banking in place, there is the life insurance aspect of infinite banking because it is life insurance. So when you start thinking about, oh, Brian, who should get a policy in our household? Well, we're going to look at the income. Who has the main income? Because we want to protect that income. Because if there's a premature death, that's what I'm talking about, by the way, premature death, we lose that income. The death benefit, which is not the focus of infinite banking, but it is one of the major benefits. We look at the living benefits more often, but we want to make sure that income is protected. So if you have two incomes, two policies. If you have only one income, protect that one income first, and then do the rest of the family after that. So we want to make sure that we have the main income earners of the household covered first, if possible. The next thing we can do as the next phase for doing infinite banking and generational wealth is children policies or juvenile policies. These are absolutely amazing. I'm going to show you the actual numbers here in a second because you can put in a small amount day one. And by the way, they have to have a social security number to get a policy, which you can get, I think it's what, 3 weeks or 3 months after they're born, you can get a policy, by the way. But since they're so young, decades of compounding are going to occur. And now that's why the Rockefeller families and wealthy families do infinite banking because they get policies on all of the family members when they are born. So here's an example. So you guys might not be able to read this. It's kind of small, I know. My apologies. So this is a 1-year-old male, born, of course, and this family said, hey, we're going to go ahead and put $150 per month into a policy. But look at this. So 25 years later, how much has this family put into this policy? They put in $45,000. The cash value 25 years later is $64,000, and the death benefit is $375,000. So, God forbid something happens to this person at age 25, but if something did happen, $45,000 is going to turn into $375,000 guaranteed and tax-free. Additionally, throughout those years, this person is using that cash value to invest, pay for cars, a wedding, whatever they want without being reliant upon a bank. But let's go ahead and look at age 65. Now, I know this is kind of hard to comprehend 65 years later, but look at what happened. $65,000 was deposited because this individual said, hey, I'm going to reduce my premiums down the road. You can do that, by the way. So they reduced the amount they're funding. But at age 65 years later, the cash value is $300,000. So 65,000 turned into $300,000 that they can use. They can use that throughout their entire life to build wealth, invest in real estate, etc. The death benefit is $614,000. So the money is worth 4.6 times what was deposited, and the death benefit is 10 times what they put in for the next generation, tax-free and guaranteed. Now, the last thing I want to mention on this example here, do you think this individual would only get one policy for $150 per month for the rest of their life? No, absolutely not. Right? When this person has a job or a business or whatever, has more cash flow, they're going to start more policies. So when you look at this example, a lot of these individuals will have between 5 and 10 policies by the age of retirement if they start when they're first born, because they're going to learn how this thing works and they're going to do more and more policies. So I want you to take that number, the $300,000, times it by 10. Take the death benefit, times it by 10. That's typically what you're going to see for someone that does this for 65 years, starting when they're age 1. Pretty amazing, pretty powerful. Now, I want to talk about grandparent policies because, as Tess has alluded to, she wished she had started this obviously a long time ago. So what does it look like if you're a grandparent and you're saying, hey, Brian, how can I do this? How can I help my family with infinite banking? So when you have a policy, and you can get one on yourself, by the way, the face amount could be used to actually perpetuate the infinite banking system. So you can use trusts, by the way, to do this, but your death benefit will fund a trust. Then that trust then has instructions to purchase more policies and fund them with those proceeds for that next generation. So what that will do is it'll create generational wealth, 1, 2, 3, mainly 3 generations deep already. Okay? You have a shorter time horizon. So a lot of times what we're looking at when we're grandparent age, we're not looking for compounding really. We like compounding, but it's not the main focus because we don't have 65 years. We're going to look at maybe overfunding a policy. Okay? And then you also can have an adult child as the owner and payer for control of it. And then, of course, health underwriting matters, but you can always fund policies on other people in your families. So there we go. I have a lot of grandparents, by the way, that get what are called grandparent policies on grandchildren. You can do that. All right. So building your family banking system over time. So I call this the waterfall or top-down approach to family banking. So as I alluded to already, you start with the head of the family. That could be a grandparent or a parent. Okay? And then you add policies throughout the generations as it makes sense. The compounding increases across time. So the compounding might not be as big of a deal for the grandparents, but if you're getting policies on grandkids, that compounding is going to be amazing throughout time. And then when you have like families like this, you don't have to rush the concept because you can get policies on yourself if you want. And then as the funds come in or you have more liquidity, you can get policies on the next generations, by the way. So we call that the family banking system over time. And so I have a lot of clients that are doing something like that. And then the next thing I want to talk about really quickly is the family banking roles. So parents as producers can fund the system with income. The kids are really the accumulators. So that's going to compound over time. Grandparents can be like the legacy transfer. So you have your death benefit that transfers to the next generation. That's how you're doing family banking together. So there's always looking at the the family banking roles. So when I'm talking to clients, that's something I'm always asking about. Hey, are you going to be the producer or the accumulator? Are you more about legacy? All that kind of stuff. So this is an actual case study. This is a pretty cool one. So this was a grandfather that approached me and he said, "Hey, Brian, I've got some funds." He took them out of actually I think it was a 401k. He liquidated because he didn't need it. And he goes, "I want to create the family banking system that I saw you talk about." So what we did is we got a policy on the grandfather. So he had one policy on him so that he could use that when he passes away. His trust is going to create more policies. So that's the first thing we did. All right. Then we got a policy on his son and his daughter-in-law. So they're both covered now. And they're gonna keep perpetuating the whole cycle. And then they have 5 kids. So we then next thing, the last phase was getting 5 policies on all 5 kids. Those are going to compound long term. So the policies the son and the daughter-in-law got, they're going to use those policies to actually pay for their kids' college education if they go to college. They're going to use it for that. They're going to use their policies for things like the kids' weddings and things like that. When the kids get older, like they're in their 20s and 30s, their policies have grown to a point where they can use that for basically any banking function that they would traditionally use a bank for. So their kids will never have to go to a bank for a car loan, even a house, by the way, things like that. So pretty cool how we did that. Took care of a lot of things. And then we created this trust system. So there's a trust involved that owns the policies. And then all of the grandfather's plans and wishes and instructions are built into that trust so that when he passes, those things will take over. And right here, family trust as the family bank. So a trust provides structure and control. The policies fund and flow into the trust. And then that ensures that the trust will then take care of the wishes generationally and it protects the family capital. So once again, you have the producers, accumulators, and legacy all feeding into that trust system. Now, one thing I want to mention is when we'll go back to what I talked about with the 401k and that kind of stuff. So with a 401k, it's crazy what happened over time. So I want to talk about this just really briefly. So a 401k, before it existed, what was the retirement strategy before the 401k? Anyone want to take a guess at what was the main retirement strategy before the 401k? Pensions. Yeah. So Tess, obviously, yeah, pensions. Do pensions really exist anymore? Not really. So a family bank is a way to help with that. But we're going to get into a topic here in a moment about pensions and things like that I want to dive into. But I got a few more slides I want to get through real quick, and then we're going to dive into the second topic. Yeah, yeah. And Tess, we know what that option is now, don't we? All right. So I want to go through a quick example of a car. I'm going to go through this one pretty quickly though. But this is how you can get all the money back for every car that you'll buy by using your own infinite banking system as the bank. Cool. First off, I want to look under the hood though. So this is what's called the tabular detail here on the right-hand side. So you're going to see some things here. So you're going to see deposits. So deposits are premiums, by the way. We call them deposits because when you deposit into your banking system, you get a benefit. It's called cash value, by the way. You'll see that over here. All right. You'll also see the death benefit. Now, 2 things I want to mention. You'll notice that the cash value goes up over time and it accelerates. It's growing faster and faster. In fact, look at year 8. In year 8, this person stops funding their bank. No more premiums go in. That's a choice that you can have, by the way. But what happens to the cash value and the death benefit? They keep on going up. By the way, that's a guaranteed thing. They're guaranteed to go up. They go up because of compounding. And so you fund this thing, and then it keeps going for the rest of your life. It's pretty nice. Age, you're going to see age over here. Now, when it comes to infinite banking, it is life insurance. So does age matter? Yes, but not as much as most people think. You can get policies all the way up into your 70s, by the way. Death benefit. As I said, it's not something that we typically focus on as the main aspect of infinite banking. It is a benefit, though. It's just a death benefit. We focus on the living benefits, using this while still alive. That's called the cash value and the living benefits. This is the actual illustration for this example. This is a real illustration. So what you're going to see here is we're going to fund this thing for 7 years, and then we're going to turn off the funding, but you'll see the cash value still continues to go up. Right? Mia Yan says, is 70 years the last year someone can get an IUL? No. But I mean, I would never recommend an IUL, which is Index Universal Life. I would never recommend that for infinite banking. but you can get a whole life at age 70 for sure. Absolutely. So let's go through this really quick. So here's what it looks like. So we put in the $10,000 for 7 years, but what's happening is we're growing cash value, building cash value at the same time. So this person says, hey, in year 3, at the end of year 3, I'm going to go buy a car for $25,000. Remember the same example we did at the very beginning. So they're going to go buy a car. Now, they're going to treat their bank like they would any other traditional bank. They're going to pay that loan back. So they're going to do it at, let's say, $500 per month for 5 years. That's $6,000. So what does the math look like? So in the first 7 years, this person put in $100,000. That's the premium deposits and the car loan repayment. But keep in mind, they also took out $25,000 in cash. So they had cash. Now, by the way, I'm using a car example here, but what if you took that $25,000 out and used it to invest? Down payment on a rental property, something like that that creates more cash flow. You're building wealth faster. All right. So at the end of year 7, this person has put in $75,000 into their banking system. But look at this. Their cash value has grown to $71,000, which means they have recaptured 95% of every dollar they put in. But now in years 8 through 12 is where it gets really fun. So in years 8 through 12, as I said before, they said, hey, we're not going to put in any more deposits. That's fine. Okay. But guess what? In year 8, their daughter turned 16. By the way, my daughter turned 16 this year. Lord help me. So they said, hey, we're going to go buy another car for $25,000. They go to their bank, take out a loan. Once again, they pay that loan back as scheduled to the point where at the end of year 12, what have they done? They've put in $30,000, but once again, didn't they take out $25,000 of cash? Yes, they did. Okay, they took out $25,000 of cash right there. So how much did they put in years 8 through 12? $5,000. But guess what? Between years 7 and years 12, the cash value grew by $16,888. And they put in $0, or they put in $5,000 through the loan, but it grew by $16,000. And they own 2 cars outright. So once again, let me kind of summarize the math on this. So what happened between years 1 and 12? They put in $80,000. That's 75 years 1 through 7 and $5,000 in years 8 through 12. But they have access to $87,000, right? $87,000, and it's going to grow for the rest of their life. And they own 2 cars outright. Pretty powerful. All right. So 3 rules of infinite banking. These are 3 rules. 1 is pay yourself first, because we're trained to pay everybody else first. Credit cards, the banks, whomever, utility companies, all that. So pay yourself first as much as possible. Pay yourself with interest. What that means is that if you're going to be the bank and borrow from yourself, pay yourself back with interest because it's going to benefit you. And number 3, recycle and recapture your money. So what does that mean? Recycle and recapture. It means that if you're going to pay off things, pay off interest, make sure that you're capturing that money and recycling it back through your banking system. 3 rules right there. All right. So I'm not going to go through this one in detail. So the other main thing that people do with infinite banking is getting rid of bad debt, because if you want to build wealth, there's really 2 steps here, 2 steps. Step 1, get rid of bad debt because it steals your money. Step 2, put your money to work. There you go. Pretty simple. So getting rid of bad debt. So I'm going to go through this one in real quick. I'm not going to go through all the math on it, but this example, which we go through on our other presentations, is a doctor who has almost $500,000 of debt, almost 70 grand per year going out to that debt, 19 years to pay it off. So this doctor says, hey, I don't like this anymore. I want to do something different. So what does he do? Infinite banking policy. He funds it with $25,000. Now I'm going to stop for a second because people say, well, Brian, where did the $25,000 come from? I don't have 25 grand. Keep in mind, that's just his numbers. They're not your numbers. They're his numbers. Now, where he got the $25,000 from was from where he was putting it previously. He was putting it into a 401k and I think an IRA. And he didn't like those vehicles, but that's all he had an option for. So he said, hey, wait a second. I'm going to take the cash going to that bucket and I'm going to move it over to the infinite banking bucket. That's what he did. So his cash flow didn't change. But what he started doing is borrowing from the policy, low interest, and paying off high interest. So he starts doing this, borrowing out, knocking out off debts. And what happens is, as he does this, his monthly payments going to the credit companies and the banks and credit card companies goes down. So he's going to follow rule 3. He's going to recapture the 448 per month, pay himself back. And then in year 2, he's going to have more money because he's paying himself back instead of paying the banks. Does the same thing, borrows back out again. He's got more cash value, knocks out more debts. What happens with monthly payment? Keeps going down. He's recycling that money back through the policy, giving him more leverage. Keeps doing this over and over and over again. So what happens at the end of year 3, this person has put in $75,000 into his policy. He's taken out $55,000. So how much is left inside of his policy earning dividends? Is it 20,000? No. He's earning dividends on the full amount in the policy, even though he's borrowed out $55,000. So once again, he continues to do this year over year to the point where by year 6, guess what happens? In year 6, you can see the numbers. It just keeps going down. In year 6, he starts a second policy. So he does a second policy. By the beginning of year 6, all of his debts are gone. But where did the debts go? Where did they go? They went into his policy. So does he have a policy loan? Yes, he does. But at the beginning of year 6, he now has all that cash flow, $5,777 that he has recaptured. So year 6 and year 7, he pays back his policy loan. At the end of year 7, he's completely debt-free, has multiple 6 figures, I believe this has a couple $100,000 of cash value in his policies that he can now put to work and invest. Not 19 years, it took him 7 years, and he built wealth at the exact same time. Exact same time. Now, if you're saying, well, Brian, that was a lot of numbers, a lot of math, how the heck do I do that? Well, by the way, we've got software. We've got the Vault software which maps out exactly what I just showed you on the screen. It maps it out month by month, tells you what debts to pay off, how to pay them off, when to do it, all that kind of stuff. So we built this software specifically for mapping out debt repayments and investing with infinite banking and the velocity banking method. So there you go. And by the way, like what I just explained to you, I have helped people do. So this is Dr. Wade, by the way. And so this is what he said. This is an email, by the way. He said, I wanted to thank you for speaking with me earlier and introduce me to another person. I now have a wealth advisor and fiduciary, and that has worked with him. And he had an existing, I think it was a IRA or 401k, I can't remember. And they created a $190,000 wealth management account, infinite banking, by the way. So he went from having about $15,000 liquid to invest to over $190,000 to invest. Nice bump, etc. Changed his entire future because he didn't really have any kind of strategy for retirement. So once again, did all this kind of stuff. Pretty cool what we did for him. Also, one of the things that we have as part of our team here is an implementation team. So this is your own guide to infinite banking, because if you're going to have an infinite banking policy or the car, right? Do you need someone to tell you how to drive the car? Yeah, that'd be nice, right? That'd be nice. So infinite banking, by the way, is not really complicated, but we have a team that's going to work with you on how to use it. So if we have a policy with us, we'll guide you and work with you on an ongoing basis. No cost, by the way, to do that. All right. So we got about 20 minutes left. So what I want to do right now, because I could keep going on about infinite banking here, but I want to pause for a second and answer some questions that you guys have around infinite banking. Then I'm going to spend a few minutes going into the next topic. Our Anthony Alexian says, how can I receive an emailed transcript of the otter notes? I don't know, because they're not mine. Those are just people that are registered for the webinar. Anthony, that's their otter notes. It's not mine, so I don't have access to those. Can I turn up my volume? I can't turn up my volume, no. Mia asks, can siblings start this infinite banking and loan money to each other? Yeah, you can start policies on yourself and loan each other money for sure. Because keep in mind, when you have a policy and you take a loan out, that's just cash. It's just cash in your hand. You can do whatever you want with it, by the way. Yeah. Is there a replay to send to our relatives? Yes, Mia. Yes, there is. And so I believe Tess put it in the chat box earlier. But yes, you can definitely do, there is a replay that goes into Chris Naugle's YouTube channel. I can't remember when it goes in. I think it goes in there every Saturday. Yeah, there it is, Saturday. So yeah, she'll put it in the link there. And then Carlton says 53. Hey, no, you're not too old, man. You're actually probably right at the average or below the average age to do for our clients that are doing infinite banking. But you can do infinite banking up into your 70s. So yeah, you're fine. So Jay's asking that, what if you're uninsurable? So there's other options. So you can get a policy on somebody else that is insurable, but it also depends upon why are you uninsurable, right, Co? So Tess will grab your email and then she'll send you that link. Appreciate that. Latanya is asking, are there any taxes paid on anything? So no, because when you fund an infinite banking policy, you're funding it with post-tax dollars. So you pay taxes on your dollars and then you fund the policy, and then the policy grows tax-free. And the death benefit is paid out tax-free and guaranteed. Now, the only time there could be a taxable event is if for some reason down the road you canceled a policy and there are gains. So that would be the only time where you might have a taxable event is if you cancel it, which is not common, by the way. Mia's asking, my dad had cancer, age 82. He survived that. Can we get a policy for him? Typically, I would say no to that one because of his age. But yeah, that would be challenging to do. But it depends upon what he's trying to accomplish or what are you trying to accomplish and what kind of financial resources do you have? I'm going to get into that here in just a moment because there are other options. Brad's asking, would it be wise to put my paycheck into the infinite banking policy and then use it to pay daily expenses? No, it would not. Just straight up, no, that would not make sense because you don't take loans to pay for those things today. Now, could you do it eventually? Yes, but it takes time to get to that point. But that would be more of a conversation one-on-one to get into that. Critical health issues, no children or siblings. Yeah, so Jay, that is one of the things with infinite banking. You would just need you need to have an insurable person to do infinite banking. Let's see here. Irv is asking a question. Can you use infinite banking to fund a retirement that you'd like to start immediately or generally not recommended? No, I would not recommend that with this, but there is something I would recommend. There's definitely something I would recommend, which I'm going to get into, but that's probably going to be more of a one-on-one conversation. And by the way, everybody, I'm going to put in the comments here really quick, my link. So if you guys want to schedule a time with just me personally, or anybody on my team, just let me know. I'm going to put this in here. That's my personal link. Or if you want to talk to like Tess as an example, reach out to her. She's on here. But that's my personal calling. So if you want to talk to me about infinite banking, just grab a time there. Or if you want to talk to Tess about infinite banking, just reach out to her. Tess, if you want to put in your link in here as well. And then additionally, if you guys want to if you want to get a phone call, you don't want to schedule a call with me, just go ahead and put the number in here. I'm going to put the number in right now real quick. We do have an 866 number that you can call. So, or if you want to put in your phone number into the, choose the, you can choose the Q&A or you can choose the host and panelist, put in your phone number and name, and I'll have my team reach out to you, or you can call that number here in a little bit. And then one of us should be able to answer it and pick up and talk to you. So Tanisha said, I tried to do this for my kids, but the company couldn't do it. So I ended up doing a 50K whole life policy for them. I regret not getting infinite banking for them, but it's possible to cancel and start. Yes, it is, by the way. So Tanisha, it is definitely an option to start and do a different policy. Just reach out to us and we can get that going. Mia, who's the carrier or the insurance company to start this? So you have to go through an agency like us, but there's about 6 companies that can do infinite banking. There is, yeah. Mario's asking, okay, you want the books? Okay, yeah, I'll definitely grab your information here, Mario. Mia's asking about how children can help aging parents with life insurance. Yeah, you can do that, Mia. It just depends on your financial means because you do have to have financial means to start your own banking system. You have to have something to put towards it, but it can be a monthly amount, that kind of stuff. Okay, yeah. So Evan, so yeah, Tess will get you the link to the books, all that kind of stuff. Evelyn, I see yours. I'll reach out to you. Do you recommend to move emergency funds from investment accounts to infinite banking policies? So I can't really give that advice one way or the other, but it can make sense. It's just a matter of where the money's at, how liquid you need it. And I typically don't recommend moving 100% of any kind of funds like that. You can move, certain amounts of it, percentages, but bottom line is, what are you trying to do? What are we trying to accomplish? And does moving those funds help with that process? That's what I would ask. Tasha's asking, how little can you start with? 10 times your age per month. If you're 50 years old, 500 per month. 60 years old, 600. Okay. There you go. And Irv, okay, so yeah, that was the question we just answered before. What is insurable interest and what qualifies? Could a charity or trust qualify? Yes, they can. They can. Insurable interest means that you have insurable interest on somebody. Insurable interest means that if something happens to that person, you'd have a financial impact or financial loss. So that's insurable interest. It's financial. All right. Let me pull up this next presentation here and get it going. I'm going to stop sharing my screen for a second. Irv says, if selling a home and looking to do a 1031 exchange, can infinite banking serve as the vehicle for proceeds to avoid capital gains? No, it cannot, because those are qualified funds and the IRS will not let you do that. But there is something you can move them into, which is called an annuity, by the way. So I'm going to get into that here real quick. I know we kind of burned up a lot of time on infinite banking because I love it. All right, let's go from, let's see here. All right, this is going to be, now we're going to be doing some more presentations on these concepts right now. But to start with, I want to just give a quick blurb about this. And then if anybody wants to reach out to me around this or test on these kind of things, just let us know. Monica's asking, can I use cash reserves just sitting with financial institutions? It depends on where it's at. If it's in an IRA is a qualified account, and you cannot move funds from a 401k, IRA, things like that into life insurance without getting into cash first. Can't do it directly. But it can make sense, but that's just where a one-on-one call would make a lot of sense. Do you recommend to move emergency funds from investment accounts to infinite banking policies? I'll say I sort of kind of answered that already once, but it depends. It depends on your situation and what you're trying to accomplish. That's really the what we got to answer. Because if there's something we're trying to achieve, does moving the funds help us with that? That's where I would go with that one. All right. So what I want to talk about now is lifetime income. So before the 401k existed, now we're going back in history, but before the 401k existed, pensions existed. What did pensions do? So pensions were funded by the employee and managed typically by the employer to provide guaranteed lifetime income in retirement. That's what they're there for. Pension, by the way, pretty cool. My father-in-law had one. My father has a pension. A lot of my in-laws have pensions, guaranteed income. But what happened in the 80s is the 401k. So the 401k, which was never designed to be a retirement strategy, came about. I won't get into the history of that. But then what happened is the IRS, Wall Street, and employers looked and said, hey, there's this thing called a 401k where if we put this in place instead of a pension, what just happens? What happens? The risk got moved from the employer to the employee. There's no guarantees anymore. There's no guaranteed income because a 401k is not guaranteed, and the employer is no longer on the hook. Also, a 401k is a cash cow for the IRS, deferred taxes, by the way, and also for Wall Street. They make fees off your 401k even if they lose money. Mind-blowing. Mind-blowing. All right. So what are sources or what are the components of guaranteed income? So the sources are right here. Income is like, so this one is a female age 65, $1 million investment. So you have principal, you have interest, and you have risk pooling called mortality credits. So that's the source of the retirement income in this scenario. Okay. But here's what I want to show you. So what are the sources of guaranteed income during retirement? There's really only three that we typically focus on. There's only really three. Okay. Social Security. Now I know what you're all going to say. Hi, Brian. Social Security is not guaranteed. Well, the government can print money, so they guarantee it. But if Social Security goes away, I guarantee you that there's bigger problems in the world outside of just money, by the way. But Social Security, you've got pensions, and then you've got annuities. So what is an annuity, by the way? Okay. An annuity is just a financial vehicle. It's, by the way, they're provided by life insurance companies, and they provide guaranteed income. So an annuity really is a self-funded pension plan. That's really all it is. Okay? Because what happens is people think that, hey, I have these assets, that's going to help me in retirement. But the success of your retirement is really not about your assets, because what can happen to assets? They can be lost, stolen, swindled, sued, divorced, decimated. It's unfortunate how many times I've had conversations with people that have assets and then lost them because of things like a divorce or market crash, and they're starting over again. It's unfortunate, but it does happen. So the question, I guess, is though, is Brian, well, why do you think that I should have secured guaranteed lifetime income? Well, these are all the reasons right here. Longevity risk, deflation, market risk, withdrawal rate risk, sequence of return risk. By the way, that's the way you take the money out. Long-term care risk, mortality risk, that's death, by the way. Longevity is living too long, by the way, too. Inflation risk, regulatory risk, taxation, the list goes on and on. But what is the number one risk? It's longevity. We're living longer, we're living longer, we're living longer, right? Because when you live longer, you're going to exacerbate the other risks because they become more relevant the longer you live. So longevity is one of the biggest risks because it is going to multiply everything else. So once again, these are all the things that when you live longer, start to become a bigger issue. Long-term care, living longer, you need more long-term care. Inflation, the longer you live, the more you're going to see inflation impact your buying power. Market risk, all these kinds of things. So how do you stave off longevity risk or take that risk off the table? Because traditional investments, think of things like mutual funds, stocks, real estate, CDs, they can't really do that. Real estate can, but not when it goes down in value. Okay. Obviously, people like real estate because it goes up. Rental rates can go up. That can kind of stave it off. But yeah, you got to be very careful with these kind of things. Now, there are things called lifetime income annuities or deferred income annuities that have they have fixed returns and guaranteed returns. They can actually accomplish everything else that a 401k, IRA, other investments cannot do. So what is a lifetime income annuity? Think of it like a personal pension. It provides you a stream of guaranteed income for life from a financial institution, which typically are life insurance companies, by the way. It's a guaranteed paycheck for life. It's pretty awesome, by the way. But the other thing that these do, which is mind-blowing, is the older you get, the more they pay. So here's some numbers. I actually pulled these up here today. I pulled them up today. So at age 65, if you do a life only, so I'll explain what life and life with guarantee means in a moment. 8.22%. That's guaranteed, by the way. It's guaranteed. 75 years old, life only, 10.87%. At age 85, 16.2% guaranteed for the rest of your life. Now, life only versus life with guarantee, you'll see those two things there. A life only means that, hey, whenever you start this thing, this annuity, you fund it, right? Income starts immediately and it ends upon your passing, your death, by the way. A life with guarantee is different. So let's use a 10-year guarantee. So that means that when you start this, it provides guaranteed income and it provides guaranteed income for 10 years, even if you die. So let's say that you get a annuity, it's paying out 6 years later, you pass on, you graduate, as we call it. That annuity is going to pay for another 4 years, up to 10 years, by the way, to whomever your beneficiaries are. And also, annuities can have a death benefit. Now, that was not always guaranteed, but they have some of the same features of life insurance. But the main focus of an annuity is guaranteed income for life. Now, if you're looking at that and saying, Brian, that's a pretty good guarantee. Why can they do that? Why can they provide a higher return than you would expect in other types of vehicles? It's because they have what's called that a longevity thing. So what happens is that the insurance companies know that, guess what's going to happen over time? Some people die early and some people die later. So if you pass on early, your funds are going to help the people that live longer. That's called longevity, by the way. That's how they calculate it. It's right here. Only a life insurance company can manufacture longevity credits. That is how they do this. So once again, only life insurance companies can do something like this, can have these kinds of products, right? Investment advisors can manufacture the payout down below. So the gray and the orange is investment growth and a return of principal. That's a 401k, an IRA, things like that, by the way. Only life insurance companies can do more than that, which is longevity, meaning that you're going to get more than you put in because some people die early, some people die later. That's it right there. So Reiko's asking, can annuities be converted to whole life with IBC? Task, remind me, what way can it go? I don't know. I don't think you can go from annuities to whole life. You can go from whole life to an annuity, though. And by the way, what can go into an annuity? Qualified money. Qualified money are things like IRAs and 401ks. Now, there's some factors, though, but it's interesting. You have a 401k, doesn't provide guaranteed income, doesn't do that, but you can turn it into a guaranteed income stream. You can do that. So yeah. All right, guys. So we're getting towards the end of the show here. So any questions you guys have, please go ahead and put those in. I'm going to start copying some of the Q&A out of it, so I have your guys' emails for the books. Yes, Tess. That's what I was trying to remember right there. So life insurance versus annuity. It's not versus, by the way. It's how do they work together. So Tess made a great comment here. Life insurance protects your family if you pass on too soon and provides generational wealth and the banking function and liquidity. An annuity protects you from living too long. Yeah. So an annuity is not really a liquid thing. It can have some liquidity to it, where you can take money out if you need to. So you can have that. But infinite banking is more about liquidity, whereas annuity is more about guaranteed income. Yeah. And you can do that. Yeah. So you can get a whole life and use that to fund the other way around. Yep. Is the underwriting different? No, it's actually a lot easier with an annuity because with annuity, it's not about underwriting. It's called suitability. Suitability. And so they're not, if you're cancer, it doesn't matter. If you've had a heart attack or you're overweight, you can't get a life insurance policy, but you can get an annuity. Yeah, Calvin, we'll reach out to you for sure. Just if you want to put in your chat, your email, we'll reach out to you. Margaret says, can you have a combination of both tied together? Yeah, they are separate things, but they can work together for sure. So Margaret, obviously, if you want to hop on a call with me, obviously we've chatted many times. Yeah, let me know because we just started talking about annuities because they do work really well with a lot of our clients. Do you have to pay taxes on annuity income? Yes. Most likely, yes. But there's different structures on how it depends upon how you fund the annuity, Warren. Depends on how you fund it. So if you fund it with dollars that are taxed, those aren't taxed because that's your base. So your base, if it's been taxed already, is not taxable. But if you take out a certain amount of money, eventually it can be taxed because you're going to start having gains. But once again, there's a ratio of how they do it, and there's a calculation. If it's funded from something like a 401k, which is tax deferred, as you start taking money out of the annuity, yes, it's going to be taxed as income. I'm going to go through the questions in reverse order because there's a lot of them there. When do you recommend setting up the annuity, like closer to retirement? So Tanisha, great question. It depends on what you have available as far as funds, because if you start funding it today, but you delay the income from the annuity, the returns are going to be greater down the road. So if you can fund it today, the annuity, and keep funding it, and then start taking the cash out of it, the income out of it down the road, it's going to benefit you a lot more because the return is going to be greater because the insurance company has more time to accumulate more funds for you. All right. And just so you guys know, I'm copying emails out of the Q&A. So if you guys have any questions, keep them rolling in. I want to make sure that we get them. If I've missed a question so far, feel free to go ahead and put that into the Q&A box again. All right. John's asking, on the car example, why didn't cash value go down 25K? Oh, man, I'm sorry. I didn't see that before. So yeah, so John, great question on the cash value. So when you borrow from the cash value with the insurance companies that we work with, your cash value still is earning the same dividends. So yes, you borrowed against the policy, but really what's going on is your cash value and the death benefit is the collateral for the loan. It's the collateral. So you're still earning the dividends. They don't change. So in the illustration that I showed you there, I don't show the cash value going down because that cash value is still in the policy earning the returns. All right, Alonso's asking, what are the fees and are they upfront or taken from the policy? So great question, Alonso. So the fees, like an insurance company has to operate. So they have cost. It's just built into the premium. That's it. It's just built in, kind of like car insurance or health insurance. And with car insurance, you don't see the fees. Because if you pay $100 for car insurance per month, not $100 is going to the insurance coverage. Maybe $75 is going to the coverage. 25 goes to the insurance company for operational costs, so it's built in. But if you want to see what those are, we actually do show you. Alonzo's asking, what is the usual minimum to invest, and is it something that needs to be funded regularly, for example, weekly or monthly? Alonzo, it can be done monthly, quarterly, or annually, or semi-annual, and it's an ongoing thing for 7 years, 10 years, and then you can turn them off if you want. Yeah, but the minimum is around 10 times your age per month. So 50 years old, 500 per month. Margaret's asking here, how soon after policy is in effect and ownership can ownership be changed? And can two people be the owner? So two people cannot be the owner, and you can change it. Well, typically we recommend 6 months, 3 to 6 months, because if you change it immediately, the insurance company is going to say, why? Why'd you change it so fast? But you have to change it to someone who has insurable interest in most cases. But if you want two people to be the owner, you can do it through a trust. So there's ways to have a trust be the owner where you can maintain that control and have maybe more than one person have access to it. Deborah's asking, what's the age cutoff for these policies? If you're female, 74, 75 years old is kind of the cutoff. You can do them a bit later in life, but it just depends on what you're trying to do. And then Kevin Kraus. Kevin's saying you can have a contingent owner as well, which is like another owner, because if the owner of the policy is not the insured, so I'll give you an example. You have a child, 10 years old, and the dad is the owner of that policy, and the dad dies. Who's going to take over the ownership? Because the child is 10 years old, can't own a policy. You'd have the wife or someone like that be the contingent owner. But they don't really have any control of the policy, though. Keep that in mind. All right, Irv is asking, so you wouldn't want to deposit a huge lump sum, but rather fund it for like 5 years? No, Irv, you could do both. You can fund it with a lump sum and then fund it over time. But there's going to be a premium on a policy no matter what. So there's going to be a premium, but then you have the option to put in a large amount in at the beginning to overfund the cash value and have it grow a lot faster. So anonymous attendee says, I have a policy but need help with mine. So since you're anonymous, I can't reach out to you. So if you want to reach out to me, I'm going to put my email in the chat box really quickly for you. All right, just making sure I got all the questions answered here. Now, Mario, I don't have access to all 5 books because the first 3 are not ours, but I do have some resources I will send to you. And then Tanisha, yeah, if you want to reach out to me, I'll try to reach out to you as well. But yeah, if you got the kids and you're trying to do policies with 50,000, oh, that's the death benefit. Yeah, I can work with you on how that would look. Can I do a policy on my husband? Yes, you can do a policy on your husband, especially. So here's the thing. So like if you have a couple and you have a non-working spouse and a working spouse, and the working spouse is uninsurable, their numbers would transfer over to the non-working spouse, and the non-working spouse can now get a policy. Isella, I'll answer that one privately. It depends. So it depends. We'd have to know what it is. But Tess can also help you with that question right there, or Linus can as well. It just depends on what it is and how long and all that kind of stuff. There's a few factors involved in that. All right. So did we miss any questions? Anybody? Okay. Here's a couple ones that just came in. Sorry. So John's asking, so you borrowed it, you pay the insurance company the interest. What if the car company has a lower rate, say 1.99%? It's still better to borrow against the insurance policy for the car. I love that question. I love that question. I'm going to come back. Yeah. So John, it's a longer answer, but let me come back to it. Deborah, real quick, can you put 100K in one policy at one time, or do we need to do more than one? Deborah, it depends. Depends on the premium, depends on the person, and what you're trying to accomplish. But I'll reach out to you on that one because that there are multiple ways to do that. Lots of ways. So what John's asking here is a great question. So what he's asking here is, hey, Brian, if I have a life insurance policy with cash value, infinite banking, by the way, and let's say the loan rate is 6%, but I'm going to go buy a car. And I go to buy a car, and let's say that the car rate is, let's say it's going to be 4%. Does it make sense to still use the policy? So John, here's how I answer that. Let's just say that you go to the car company and get a car. Who dictates the payment? The car loan company, the bank. Okay. If you miss a payment, what happens? They take your car. Who has the title? Not you. The car company does, excuse me, or the bank does. Okay. So that's that right there. With a policy loan, you dictate the payment because with a policy loan, there is no required payment on the loan. You choose when and how to pay it back. If you miss a payment, as I just said, nothing happens. So nothing happens. So they don't come take your car. And then since you are the bank, who has the title? You do, because you are the bank. So you have the title. So when you think about those things, I like a policy better. Also, the car loan goes on your credit report. The policy loan does not go on your credit report. It's a private loan. Now, is there a scenario, John, where you would actually go to the car company and get a loan from them? Yes, there is. Let me give you an example. You go to the car company, get that loan, 4%, that's fine. You go to your policy, you borrow the money out of it, and you private lend it on a real estate deal, and you're making 15%. You're paying your policy back, you're keeping the spread as profit. That spread can pay for your car loan. That, as an example, could make sense because you're doing more things because you have an investment, which is an asset, by the way, paying for the liability, which is the car loan. So that can work. Tanisha says here, I've been saving up money in an HYSA to purchase my kid's first car. Should I just be putting all that extra money into my policy instead and just use that to get their car or just keep them separate? Tanisha, that's a great question, but once again, the answer depends upon your policy, the structure, and how you can put the funds into it. So as an example, this is a great question, by the way. So Tanisha is saying, hey, I'm saving money over here in the savings account, but I've got a policy over here. Now, I don't know how your policy is structured or how it's set up or if it has loans, but let me give you an example, Tanisha. If you have a loan on your life insurance policy, you should not be saving money to a savings account for that car. You should be putting that money into the policy loan because that's going to save you interest on the policy loan. And when you need to buy the car, take the money back out again. So it just saves you money by parking it in the policy loan. But once again, that might be a conversation one-on-one to understand the dynamics of what you got going on. Monica's asking here, can I use a policy loan to pay for an investment property? Yes. For example, borrow $250 against myself. Can I loan it to my own LLC? Well, one, that'd be a large amount because for infinite banking to have $250K, you'd have to fund it with a large amount or it has to grow to that amount. So when you take the loan out, that's just cash, by the way. It's just cash. What you can do with that is you can then lend that money to your LLC. You just have like a one-page note or a two-page agreement between you and your LLC on the terms, and there you go. I've done that many times. Yeah. Or you can do like an owner deposit or owner funding of the LLC as well. So there's different ways you can do that. And would I still acquire the interest on the loan? Yeah. So the way I've done it before, or I've had clients do this, is they'll borrow from their policy. Let's say it's 5%. Okay, that's the rate the insurance company sets for it. They borrow from that, and then they say, okay, I'm going to lend it to my LLC for 5%. It could be 5%, right? Then your LLC takes that money and puts it out over here to an investment. Let's say that investment returns 12%. So when that money comes back, so it comes from the investment back into the LLC, 12%, okay? Then 5% plus the loan goes back to you, to your policy, and you keep the 7% spread in the LLC. That's one example. The other example is you take the spread, the 7%, and if you can, you put it back into your policy. There's lots of ways to do that. You just got to kind of map it out mathematically, and it has to make sense to you. But we help you with that, by the way. And we have software too that will do that, maps that whole thing out. So, yeah, good question though. Jay says, since I'm single with no kids and due to health issues, can I get a policy on a healthy beneficiary of a trust to start infinite banking? So yes, we just have to understand the insurable interest on that situation and how the trust is involved. Because there's three parties. So by the way, for everybody listening, there's three parties involved in any life insurance policy. Doesn't matter if it's infinite banking or not. There's three people. The insured person, you've got the beneficiary, and you've got the owner. All three can be different individuals or entities as long as insurable interest is there. But in most cases, the insured and the owner are the same person. In Jay's scenario, he wants to be the owner of a policy, but the insured is going to be somebody else. And then he could be the beneficiary, or the beneficiary could be somebody else. Hope that makes sense. Okay. All right, Tess, I'm gonna assume that you got most of the emails that are in the comment box. I got a lot of the ones that were in, I got all the ones in the Q&A box. And by the way, on the annuity stuff, so we are going to be putting together more presentations on that as we move forward because the annuities can solve a lot of situations and solve a lot of problems that people have. If you have, qualified dollars, IRA, 401k funds that you're saying, hey, is this enough for retirement? I don't think it is. What can I do? Let's hop on a quick call about this because you can potentially move those funds to a better vehicle that can get you guaranteed income and can help you, and it can even take care of your family as well. So there's lots of different ways that these can work for you. But it's just we have to look at your situation because they got to be designed for you. All right. So we went long, as always. That seems to happen when I'm on these calls, but I love it. All right. All right, Isabella. Yep, absolutely. Yeah, we'll reach out to you. Tess will reach out to you or Linus. All right. Hey, Carrie, how are you doing? Good to see you here. All right, everybody. Appreciate all the questions. Appreciate all the comments and stuff, and appreciate y'all being here. With that, take care, and we will see you. Actually, by the way, I'm going to be hosting Ask Me Anything here in a couple hours. So it's about what, an hour and a half, a little over an hour and a half. So if you guys want to hop on and go to Chris Naugle's YouTube channel, which Ted did put a link in there, but just go to YouTube and type in Chris Naugle and then subscribe to his YouTube channel, and then you'll get a notification when we go live on YouTube. Okay. All right, guys, take care. We'll talk to you soon. And Kevin, I hope I see you on Ask Me Anything as well.